The managed futures industry has been evolving over the last few years to include not only hedge funds, but also we've seen a greater movement towards managed futures mutual funds as well. There's a couple of different regulatory ways that managers tend to work with both hedge funds and mutual funds, either as a CTA or as a CPO. And we've seen an increase in the amount of groups, both on the hedge fund side and the mutual fund side, who have found a need for these sorts of products within their portfolios. You've got the traditional groups, the CTAs, the CPOs, even to a certain extent the IBs and the FCMs, who really see the fact that the future strategy, the managed future strategy, is seeing a lot more inflows. Let's say you've got a CPO, a hedge fund manager who's doing commodities. He wants to have a couple of separately managed accounts, either running the same strategy or a different strategy. Maybe they've got a very large investor who likes the central strategy that's in the hedge fund, but they want to see a separately managed account strategy that is doing something similar but maybe a little bit different. What we're seeing is a diversification away from just one strategy, where a CTA used to be just a CTA and only do separately managed accounts. Now they might be branching into these other products just to widen their potential investor base. The way that the mutual funds themselves are set up on the managed futures side is kind of one of two ways. There's groups who are doing just sole single structures, and that's where they are going to just create their own mutual fund product. They're going to market that product, and they're going to be the only ones in that product. That's kind of a single manager structure. What we're also seeing is the movement towards a shared platform or a series trust. And with the series trust, a series trust is typically sponsored by an administrative firm who will gather the various service providers and create a platform for managers to come in as a separate series. And so the administration firm is really in charge of making sure that the back office for the manager is kind of up and running. The manager doesn't have to worry about any of the operational aspects. They just have to run their strategy as part of a shared platform. You've got the administration firm, you've got the transfer agent, you've got the pricing agent, you've got the accounting, and you've got the distribution to the various broker networks, where ultimately the brokers are going to be out there selling to the retail investor. All of that is kind of developed as kind of a turnkey package by the administration firm. You're running a commodity pool, a hedge fund, you're going to have to be registered as a CPO. And that means that you file paperwork with the CFTC, you become a member of the NFA, the owners of the manager need to have the Series 3 exam, you need to have a compliance program in place, and in general, you need to make sure that on an ongoing basis, the firm is following all the compliance procedures. The managers to those mutual funds are now going to have to register as CPOs. So this means that those mutual funds are going to have to go through kind of the same process that the hedge fund managers have to go through. And so you're going to have to register, you're going to have to become a member of the NFA, and you're going to have all of your marketing materials subject to the NFA rules. You're going to have to go through the back and forth process to have your prospectus ultimately approved by the NFA, and these sorts of things. When you have banks and other institutions that previously had been allocating all of their money to or not all of their money, but allocating assets to hedge funds and that sort of thing. And now those vehicles may not be acceptable vehicles to allocate money to anymore. You're going to see that money being allocated into more liquid registered products. And so the fact that mutual funds and managed futures mutual funds are acceptable products to be invested in means that there's likely to be a lot of assets flowing into these registered products. Investors, especially after the last couple of years, are looking for products that aren't necessarily correlated directly to the stock market or the bond market, and obviously the managed futures markets provide that sort of a product. So these products, whether they are mutual funds or other sorts of registered vehicles, are likely to continue to see a lot more asset flows. Additionally, what you have is a lot of kind of regular RIAs and financial advisors who are seeing from their clients more of a demand to diversify their portfolio. And so as part of that diversification, certain slices of the portfolio are going to go to managed futures products. And as a registered product, it really creates kind of an easy allocation for a lot of these registered investment advisors who don't necessarily want to go in and be trading in the futures markets specifically. And it's going to be the easiest way for them to do that instead of going out and researching the various CTAs and trying to set up separately managed accounts and these sorts of things. So we see that as a really good distribution channel for these managed futures funds as well.